Welcome to today's Corporate Venturing Insider Series. Today, I am so happy to have Gina Domanig, Managing Partner at Emerald. You are a celebrity in corporate venturing, and I'm so glad to have you today, coming from Europe, which is why it's 1 a.m. in California. But it's not too bad for us because it's morning for you and evening for me in Taiwan. Gina, welcome.
Thank you. Thanks for the invitation, Nicolas.
Thank you. I always start with asking for the journey into corporate venturing. And you are not a CVC, but you are definitively involved and influencing corporate venturing. Would you mind sharing your journey into corporate venturing?
Sure, happy to do so. So it's perhaps important to note that although I've been doing this for 22 years, I did have a life prior to Emerald. And I was actually working at a large Swiss industrial technology company for 10 years, running strategy and M&A. So when I started up what is today Emerald, I came in with a view that there was really an important relationship there between startups and corporates that needed to be fostered. So right from the very beginning, Emerald had corporates as part of our LP base. And over the years, it just became more and more clear to us that that was an area that we wanted to focus on. So since 2012-ish, we've had mainly corporates. And obviously, as we tell our portfolio companies, decide who your target customer group is, align your strategy, your processes, and your resources to be, to have the strongest value proposition. So that's how we got into it, and that's why we ended up really focusing on working with corporates.
Okay, but how did the idea start, and how did you know with whom you wanted to partner?
Yeah, so for us, it was clear from the beginning. We started out being sustainability focused because I had come from industrial technology. We decided quite quickly to focus on the industrial sectors, and so that was clear already kind of from the beginning. What was the challenge? The underlying hypothesis of Emerald from the very beginning is that the sustainability trends are going to create a lot of challenges, but also a lot of opportunities for the industrial corporations. And we want to be, basically an accelerator, enable the transition for those corporates. It's actually, to tell you the truth, it's just a lot of fun working with the corporates. We gain a lot from them as individuals, and our portfolio companies can gain a lot by working with them. And obviously, they're not just interested in the financial returns, but they're also interested in the strategic relationships that come out of that collaboration. So for us, it was a pretty easy choice. To decide to focus on working almost exclusively with corporates.
Maybe I should give huge credits to Emerald because my first training on corporate venturing, that was January 2019, I had Marcus from your team talking and training about corporate venturing. And first, Marcus is amazing, but two, it was my first experience. And I still remember how he talked about your limited partners and the entrepreneurs and looking at both as how do you add value to both? It's not one or the other. It's not a forced choice of choosing one or the other, but bringing value to both. And I'm sure, like you mentioned, strategic value, financial value, same thing. It's not a forced choice of one or the other. So maybe we start with that. How do you react when people say, are you strategic or are you financial?
Yeah, that's a good point, right? I think for us as a venture capital team, we need to generate really attractive financial returns. Otherwise, we don't have a reason to continue to exist. But irrespective of those financial returns, if our corporate LPs don't achieve the strategic impact on their business, they will consider the relationship a failure. Right, even because we're dealing with the corporate development guys, the CTO's office. If they've got a CVC, we're working with the CVC guys, right? So their mandate isn't go out and find great investment opportunities. They've got a treasury department that's responsible for that. they're really looking to move the needle on their business, right? So that's very important that we always have that in mind, that we need to generate financial returns as a firm, and we've chosen to work with a certain customer group or segment that has additional goals as well. So with each one of our LPs, actually, we agree on KPIs. And we review those KPIs every 6 months. And, you know, they have a lot to do with knowledge transfer. Some of them have actually goals to make co-investments. Others have goals to, you know, acquisitions, you know, joint development agreements. So there's many different ways that the corporates are looking to engage with those startups. And it also changes over time, right? So I think that that's important, that we have a system in place that makes sure that we're achieving both of those goals simultaneously.
I think that's the first golden nugget, and I want to double click on it, because you're talking about process, but you also have a platform for the limited partners to have access to information. So let's start with a process. How do you onboard limited partners? How do you define these discussions around KPIs? How do you follow through on these KPIs, and how do you shape your team to deliver on that?
Right. Yeah, so that's a really good point, because we believe that the process will drive, or let's say you could also have design failure, right, by having the wrong process or having a lack of a process. Sure. And we really shouldn't leave this just up to luck, if you like. So we have a very clear onboarding process where we sit with the people from our team. We always have a partner in one of the sector specialists in our team who are assigned to work with a particular corporate investor. And we sit down together and we try to understand what their strategic priorities are. What do they as a team also, you know, again, sometimes we're working with the CVC team. So what are their KPIs, and which one of those KPIs can we make a contribution towards achieving? And then we agree on what our KPIs should be out of that. And then we've got monthly calls. So as you know, we've got a IT, you know, platform for our LPs to access the deals that we review. We're reviewing about 2,000 deals a year. We have 3-page write-ups on each one of those companies. So besides the corporates being able to tap into that and to extract information from that, we've got a monthly call with each one of them individually to talk about specific areas of interest from them, or specifically about some of these startups, right? And so that kind of kicks off a whole process about engaging then with particular startups. And the interesting thing is, it's irrespective of whether we're interested in investing in that company or not, right? Because just because we think a company is overvalued, or they have a really capital-intensive business model that we don't really want to invest in, it doesn't mean that it's not the perfect counterpart for our corporate investors. So it's important that we also spend time. That's why we have such a large team, right? We spend time reviewing deals that could be of strategic interest to our corporates. So we've got those monthly engagement, and then every 6 months we have a sit down with our investors individually to talk about the KPIs, also to find out what has changed on their side, right? Yes. Because these are very, very long-term relationships, and their strategic interests and their internal goals and you know, also restrictions will change over time. So we've got that process, and of course, twice a year we have our investor forum anyway, so we're going to meet there as well. So I think it is important, if one chooses to focus on working with corporates, that you also have, like I said before, the processes in place to ensure, also if there's a change on the corporate side, that somebody new doesn't come in and go, okay, so what have you done for me lately? We can easily pull out a sheet and say, this is what was agreed and this is what we delivered, and we can, you know, not have, if you like, a gap in the relationship.
I think there's a golden nugget you just mentioned, which is the strategic value is not limited to the portfolio companies, the companies you decide to invest. it's all the startups you're looking into a space and what you learn from them, and some could be good engagements. Which tells me also you're not a typical VC, because you have so many entrepreneurs, and these entrepreneurs should talk with you, because even if you don't invest, you can still plug them into different corporations.
Exactly, and we do that quite actively, right? We know what type of companies our LPs are looking to engage with, and we can identify them in our deal flow, or we proactively go out and scout for such companies, and then we can put them in touch. And I think that it's tough for startup companies to raise funds, right? And so I think that even if we decide not to invest, it shouldn't be a net negative experience for those entrepreneurs. It should still be a positive. They should get something out of it. And so we're always very, very willing and eager even to make those connections to the startup companies with our LP base, right? So that even if we decide to invest or decide not to invest, that they hopefully have gained some important connections to potential partners or customers within our LP base.
And so I can imagine that this type of introduction is probably a KPI for some LPs. I want to ask about Emerald's own KPIs, your internal KPIs. Do you track this number of introductions? What do you track inside Emerald?
Yeah, well, we have Stephen Marcus is responsible for customer success, and the reason why we can't really have one KPI, because each one of our LPs is so different. Now we've got, I think, 43 corporates, and each one of them is different. And as I mentioned before, it also changes over time. So we kind of use a dashboard internally to give kind of the health of the relationship with each one of those corporates, kind of, on a red light, yellow light, green light, just to see, are we on track? And then we can also take corrective action, right? If we see that somebody had a goal which maybe it's actually unrealistic, right? Maybe they're thinking, okay, we're going to acquire 10 startups a year. That's going to be a little bit difficult to actually achieve that. And we try to manage expectations. Also, we propose KPIs to them. Some corporates actually think that or the individuals think that they're in a beneficial situation to not have KPIs. And we challenge that quite strongly, because we think it's important that they can also internally demonstrate that they're achieving their goals.
If anything, you're helping them communicate better internally about the value they get, right?
Exactly.
Now, another thing which is not typical is you have a large team. So can you tell us about how you shape the team, how you maybe have an investment team and a customer team, and I don't know how you name them, but how do you shape your team over time?
Right. So we have, we distinguish obviously between the investment team and the support team. So in the support team, we've got people in legal, in marketing, in HR, fundraising, customer success. So we've got a lot of support functions because of the large number of portfolio companies we have, the large number of limited partners, and obviously the large number of team members. Then within the investment team, that's something that I think is a little bit unique. We've got a very large technical team, which we call our sector specialists. And these are quite experienced people, not just academically, but also professional experience, right? It's not necessarily people who are just out of university. You've got people who spent, decades in a particular industry, reviewing deals within that industry. We're very, very lucky in that we have a really long history, would say, with Emerald. So the average length of service of the investment team is over 11 years, which helps to kind of keep that knowledge internally. And these sector specialists, they make up about 2/3 of our investment team. And they're the ones who are actually playing a very important role in scouting deals. And they are also the ones who do the initial review of deals, right? And they're really looking for what's the market opportunity, what's the value proposition, what's the competitive advantage of this particular company. And then if they think, hey, this looks quite interesting, they bring it then to the whole investment team. And obviously the rest of the investment team are finance specialists and also the partners. And if we decide then to look at a deal, we put together a 3-person team. One, obviously the sector specialist that brought it, one of the finance people, and one of the partners. And that 3-person team stays with that investment through the entire life of the investment, all the way through to exit. So, because portfolio companies need different types of help over their journey, if you like. Sometimes it might be IP strategy, it might be about exit, it might be about organizational development. So it's important that they have those resources.
I really like this 3-person team. Now, is that the 3-person team before the investment that's going to make the argument to invest in the company, goes to the investment committee? How do you get from the we like this company to the investment?
Yeah, there's a lot of due diligence. I mean, we're known as being quite thorough. I'll say it in a positive way, right? We really want to understand what kind of challenges the company is going to go through. So if they're well set up, this could be a 2 to maybe 3 month process, right? Where we visit the company, we do financial due diligence, we do a lot of market competitive analysis as well. The last part of it, obviously, legal due diligence as well.
Okay, and what's the process for then making the decision? Do you have an investment committee where you get the pitch from this 3-person, or is it just the investment director who's making the proposal?
Oh, sorry. Yeah. So we have an investment committee, right? So in the investment committee changes composition depending on sector. So, for example, if it's one of the energy deals, then we've got one of our partners, Christopher, who's kind of the energy specialist. He's the one who heads up our energy fund as well. So he will then join, if you like, the core investment committee, which is Marcus, as you mentioned before, Hans, Charles, and myself. So the investment committee has different, there's different gating points, right? So first, obviously, the sector specialist brings it to the attention of the team. The investment committee decides, is this something we want to put together a deal team on to investigate more? And then that deal team will go off, and then they have quite a bit of freedom, if you like, to also to stop working on a deal, to say, look, we found certain things that make this no longer that attractive as we originally thought. And then it culminates in what we kind of erroneously call a preliminary assessment, which is actually about a 70 to 80 page document.
Very preliminary.
Exactly, very preliminary. But we are located in Switzerland, so we're very thorough and very accurate about everything. And that's really the key investment document and the key investment decision. And that's one thing that's also maybe a little bit different. It's typically only after that do we issue a term sheet. So we don't really appreciate this trend, if you like, of VCs to lock up deals very, very early in the process, get these startups into exclusivity when the VC themselves is not really sure whether they want to invest in that company. And it's unfortunate because I think a lot of times the startup companies are pushing the VCs to issue term sheets very, very early. But all they're doing is they're asking for a kind of a lower quality commitment disguised as a term sheet, right? Because the VC, just because they issued a term sheet, it's not going to make that big of a difference as far as whether they're going to ultimately decide to invest or not. So we try to encourage the startups to wait until we really are sure. I mean, if something passes a preliminary assessment within our process, we're 95% sure we're going to make this investment. It would really just be something maybe during, if there needs to be an additional patent review or legal due diligence, something really unexpected happening at the last minute, that would cause us to not proceed. Yeah, but we also work in a sometimes a competitive market, so we do need to adjust a little bit if we realize that it's a really interesting company. They're demanding a term sheet. We just try to make it clear to them that this is a little bit too early for us, but we'll do it.
It's a golden nugget for the entrepreneurs who are listening to us now, which is clearly you want the term sheet to come in, and you probably want term sheet to come in so that you can trigger other term sheets, but you want quality term sheets from VCs that are committed and they know they actually want to follow through. And trying to push too hard for a term sheet too quickly probably doesn't serve you well.
No, and especially because the VCs are very often asking for exclusivity, right? Which I actually think a better practice would be asking for a placeholder, right? Saying that, look, if you sign this document, you won't do another deal excluding us. But we definitely recognize that you need to continue to ensure the existence of your company, and you need to continue to talk to other investors, right? So I'm much more in favor of a placeholder than exclusivity, because I think it's more fair towards the startup company. But I think I'm rather an exception.
No, but I think your point is about a commitment not to go exclusive with someone else.
Yeah, exactly.
It's like when it's probably a poor analogy, but when you go with real estate agents and they push you for exclusivity, it's actually not in your favor.
Yeah, and when we do also our term sheet, we have a lot of things in there that are really for the protection of the startup company. Because if we're an investor in that company, we have a very, very strong incentive to see that company survives. So we have certain terms in there like pay to place and things that maybe seem a little bit aggressive vis-a-vis the investors, but are really for the benefit of the startup company. And that's because we believe, if we're invested in that company, we need to be fighting for the startup company, right? And if we lose faith in a startup company, then the truth is we should walk away, right? We should basically sell our shares to the other investors for, I don't know, whatever the lawyers are going to charge us to draft the documents. And then we should wish them good luck and be professional about it and not stand in their way. Right?
Yeah. And part of it is securing the next round of financing. So you just mentioned pay to play, which I'm not sure all everyone in the audience know what this is. And could you explain what this is, but also why it's good for the entrepreneurs?
Sure. So, pay to play is really designed for a situation where the company has hit a road bump. It may be because of the entire economic environment. It could be something like COVID. It could be like a war, economic crisis, whatever it might be. It might be because the company's own internal situation, right? But it's a situation where the company needs to raise money, probably at a down round, so at a lower valuation. And it's a mechanism that basically says, you internal investors will all contribute your pro rata to this financing round. And if you don't, there will be certain consequences, right? And the most draconian, which I'm a big fan of, is basically saying you will step off the board, your preferreds will be converted to common, and you no longer have an ability to influence this company, right? Because if the company gets in trouble and you're not willing to actually help them at that point in time, then I don't think you have a right to continue to voice your opinion and to influence that company, right? Now, granted, there are situations where an investor, perhaps it's a smaller investor, and they're not able to invest more because they simply don't have the money. We're also quite flexible there. If they can bring somebody else to the table who will invest for them, kind of replace their investment. The main thing is getting the money together, right? Yep. Because what happens is So let's say you've got 4 investors. One of them says, oh, I'm not going to invest because I'm really concerned about the future of this company. Great. So what happens? Then the other 3 have to do more than their pro rata. And so what does that do is that then the terms get more and more severe, right? And then you've got a startup company that maybe was only going to do a 10 or 20% down round, who's all of a sudden in a situation who's doing a massive down round in order to incentivize those to invest and to punish those who are not going to invest. So if the punishment, if you like, is already baked in this pay to play, basically saying you're being converted and you're going off the board, then it hopefully will avoid the need to go into this tailspin on valuation. Because if the company needs to raise money later, it's not in any of our interests to have done a draconian down round right beforehand, right? Because you're really resetting the valuation for the future. So, management gets wiped out. Then you've got to go through all kinds of new compensation incentive programs. So it's really to avoid that situation. And after 22 years, you can imagine. Unfortunately, we've seen our share of economic crises and down rounds. So we just find it's the best way to protect those startup companies.
And I want to get into the topic of down rounds and topic of economic uncertainty, because clearly we are going into, if we're not already in. But I like the way you've described the pay to play. And my own very high level view was, you have 3 types of investors in this situation. You have the one that still truly believe in the company, no issues. The one that stopped believing and it doesn't make sense for them to continue. And you have the ones in the middle that kind of like the company, they wish they would continue, but they're not willing to put their own money. Mm-hmm. And you're basically forcing them to choose one camp or the other.
Exactly. And you know what, this has worked, right? I have many, many examples where, because of the pay to play, they have invested, they have participated. And if we had allowed them to just sit on the sidelines, they would have passed, right? So forcing them, I like the way you phrase that, forcing them into one camp or the other really gets them off the fence, and it allows the company to raise money, I think, that's needed, right? And even our most successful companies, almost every single one of them has had a near-death experience, right? So it's important that the investors are prepared for it. They know that these are kind of fragile organizations, right? They will hit speed bumps. These entrepreneurs are by nature overly optimistic, and unfortunately, the world doesn't always comply with their assumptions. And so it's important that the investors understand the responsibility also that they're taking on when they do choose to invest in the company.
And I speak as a CVC. There are times where I personally still believe in the company, but the company is not doing so well. I still believe they will make it. Mm-hmm. And the play is actually a really good tool for me to go back to our investment committee and to say, I still believe in it. I wish to do a little more for them. By the way, if you decline, the position we have would be totally compromised. That also helps. Exactly. So even for corporations, limited partners, CVC, I think it's never one person deciding. It's actually an investment committee, multiple people behind it. The pay to play is actually good. I feel like we've talked enough about the pay to play. I want to talk about the uncertainty of the environment. We're clearly going through a deglobalization. We're clearly going through economics, inflation, sorry. So I wonder if you could talk about your past experience and how you see today being different or the same as before.
Yeah, there are certainly some similarities, right? So if you think about when we started, kind of just at the .com disaster, and then of course we had the economic crisis in 07, 08, and there are certain learnings out of that I think are very relevant. and that we have internalized already after the last financial crisis, which puts us in, I think, today a much better situation. I think our portfolio is much, much more resilient today than it was going into the last financial crisis. And I think that, first of all, what a lot of the people in the VC industry are surprised about is the impact on our sector comes a bit delayed, right? Because the companies going into financial crisis, not every company has run out of money, right? They still have money. The VCs probably still have dry powder and stuff. It's what happens, kind of 2 years afterwards, right? Where the companies have run out of money, the VCs have perhaps not been able to raise follow-on rounds. The CVCs maybe have come under pressure because their corporate parent it has some economic constraints and stuff. So there is a bit of a delay. So even if the VCs right now don't feel the pain, I think one needs to be careful. We're definitely already, like I said, after the last financial crisis, we became much more focused on companies raising enough money with the right group of syndicate partners who can then take them through a crisis, right? So we have even, sometimes we'll even cut back on our allocation within an initial investment round in order to make room for somebody who we think would be a really good syndicate partner. We definitely encourage the companies to raise more money because, like I said, they're always overly optimistic. So we always tell them, look, take a bit more money for a rainy day, right? So I think that has also shown now in our portfolio. We have got very few companies in our portfolio that we think are going to need to raise money within the next 12 to 18 months. But also the type of investors, right? I think if you think about the last financial crisis, there were a lot of, let's call them generalist funds that were kind of jumping into this sector. And as soon as kind of the going got tough, they all left and left us kind of holding the baby with these portfolio companies. So we were much more careful about who we have co-invested with in these startups. So I think our syndicate partners are also very, very strong today. I'm really happy with the type of co-investors that we have. And also, I mean, we've been more careful about investing in companies that have high capital needs, whether that's because they have a capital intense, kind of CapEx intense model or OpEx intense model, right? And we are also known to be a firm that's quite skeptical of companies that are, running burn rates in the millions per month with very little visibility on how they're going to get out of that situation, right? So it's rare that you'll see one of our portfolio companies with a really, really high monthly burn, unless, like I said, unless there's a very clear path on how they're going to get to cash flow break even.
So you touch on two very important points. One is the art of building a syndicate, and the other one is about how to think about investing in capital-intensive companies, especially in industrial, being even more so. Let's start with the art of building a syndicate. Any best practices that you want to share with the audience about how to think about it? You already hinted that sometimes you leave a little space for others to join because they can add value. So how do you think about syndicate and help the startups be successful as a consequence?
Right. I mean, I think there is a certain comfort in numbers, right? So I think having, four, at least 3/4 good syndicate members is important because you just don't know. I mean, it could be one of our, fantastic corporate CVCs that we've made tons of co-investments with. They get a change in CEO. The new CEO comes in, hates corporate venturing, or who knows what could happen, right? So I think it is important that there's enough number-wise, enough people at the table that we can survive one of them dropping out unexpectedly, right? So I think that's one thing. The other thing is, maybe we're in a luxury situation to say this, but invest with people you know. right? That's the best way to get to know, if somebody's a strong syndicate partner is if you've done an investment with them in the past and you've seen how they operate, right? And I think people should not be hesitant to ask questions. Do some due diligence on your co-investors. If somebody is going to invest with Emerald, they should ask us, how much money do you have? Where are you in your investment cycle? How do you guys take your decisions? The startups should ask that, although I think a lot of startups will actually understand the consequences of some of the answers. But it should really be the other VCs that are either already invested in the company or joining the syndicate, who are very, let's say, frank and open with each other. And if somebody says, hey, look, I've got a 35 million fund, this is the last year of our investment period, okay, then I don't think it's a really good idea that you take 5 million in this round. Maybe you should only take 1 million, right? And try to manage the risk already before the investment actually starts. So I think that's what I would also say. People who are dedicated to the sector is also extremely important. I kind of alluded to it with mentioning the generalist funds, right? But if we're co-investing with a big automotive company in a mobility startup, it's highly unlikely that they're going to change their strategy away from mobility, right? So having, whether it's the corporate VCs or the independent VCs, but having a confidence that they truly are committed to the strategy is important.
I really like, and it's back to what you were saying earlier about specialized team and sector specialist. So how do you think about single GP funds? Because they are arguably specialized because of their passion, but do they really bring a good syndicate? How do you think about them?
So these are GPs who have multiple corporate LPs, or
No, I meant the single GP. So they have one GP who's in charge of the VC.
So one.
And maybe it's more common in the US, where you have typically partnership with multiple GP and they all make decision as a partner.
Ah, okay. You mean the GP not as a legal entity, but as a person?
Yeah.
Okay. Sorry, I was misunderstanding. I've never worked in that situation, so it's always a risk when it's one person, right? Again, I like comfort in numbers, and even our investment process, I can actually get outvoted, right? A lot of people are surprised when I say that, but I don't know everything, right? And if there's 5 people on the investment committee, and my other 4 colleagues are super excited about this, and I have a concern, and I'm the minority, I can get outvoted. So I do think that a firm can be more consistent, and also for the outside world to understand who they are. I think it's better. Some corporates are set up like that though as well, but where there's really one person who takes the decision. So it's not just a phenomena that's with the independent VCs. I think any firm which is dependent upon one person's opinion, I think has a higher risk, right? And is not as predictable, if you'd like, as if it was a committee that's taking the decision. Although the committee needs to be able to act quickly. I mean, that's the great thing about kind of these single decision maker setups, is that usually the decision can be made very, very quickly. And I think independent VCs like us, who have multiple people on the investment committee, everybody has a very clear understanding that we must be able to take decisions within a 24-hour period. And I think the corporates, that's also something that we impress upon them when they're setting up their CVC, to make sure that that investment committee realizes kind of the sense of urgency. Going back to the issue about a startup company needing kind of an emergency rescue round, right? we can't wait until the next board meeting next quarter, right? It really needs to be a decision taken, and maybe even those corporates should delegate the authority to their CVC team to make follow-on investments up to a certain amount, right? So that they can act very quickly.
That's golden nugget again. And I think the follow authority is a good one, because at that point it's much more about financial than strategic. I also really like your point about outvoted. So at TDK Ventures, by design, I don't have a veto right. And the way, that's what you said, is don't have the veto right. If other people who are so passionate, so research, believe it should be done, you should give them the chance to go and make the case.
Exactly. In the end of the day, we're all trying to take the best decisions, right? And none of us have a crystal ball, right? And we're very consensus oriented within Emerald, but somebody can be outvoted, which I think is important. But once we've taken a decision, we're all in it together, right? Our carried structure is like that. Everything is, and we even have cases where we will change partner on a particular portfolio company because either because of the simple amount of work that's involved, so it could be a workload issue. It could also be that now the company is going into a different phase, and there's a better, a more suitable partner within our firm to then be on the board of that company. So we're very team oriented, and I think that's also a reason why we've been around for so long.
In a way, you're describing a disagree and commit.
Yeah, exactly.
I really like that. But also, venture capital is about being right a little early when it's not yet obvious.
Exactly. Although, one of our claims to fame is that in one of our early funds, we made 2 investments in wave technology, and we're still waiting for that to happen. So being too early can also be costly, right?
I think you need to be a little too early, so it's just in time for the next round of financing, maybe, but not 10 years early.
Exactly. But you mentioned before in kind of the trends, right? So you've got, kind of this anti-globalization, right? So already my colleague Michal, who covers the robotics and automation sector, he was already saying, at the beginning of this trend, hey, we're going to see a very positive impact now on robotics companies, on anything that has to do with automation, because there's going to be a return onshoring, basically, of manufacturing, which is in some high wage countries, like we have in Europe, obviously in Switzerland, but also Germany, in Japan. And so you're going to see a real push now for automation, and it's not going to only be the very, very big corporates. It's going to trickle down into the medium-sized companies as well. So it has to be automation and robotics technologies that are also accessible to medium-sized companies. So you see, kind of a positive trend, but being there early and understanding how this trend is going to impact the sector that you're responsible for is a really important role that our sector specialists play.
I completely agree. Now, there's one thing I love, which is about decision-making science. And I wonder if you have tracked some statistics about the best investments, whether from the one where everyone agreed on the investment, or whether from the one where there was a disagreement and someone was outvoted.
It's interesting. I actually intentionally don't go back and look to see how people voted, because I don't want to kind of create a finger pointing. We know each other really well, right? So Hans, Marcus, Charles, and I, we've been working together for 20 years, right? We all know each other's sensitivities. We all know kind of, what's your hot point, and what type of deals do you actually really like, and what kinds do I really like. And it's important that, that we're in sync enough, right, that we can take good decisions, but it doesn't mean we always have to be of the same opinion. But yeah, to get back to your question, no, I have not gone back. What we do go back, though, is we see why were we wrong on projections, right? So you'll always be wrong, right? By definition, you'll be wrong, but to be dramatically wrong, right? So what was it? What assumption were we taking about a particular industry, a particular technology, a particular management team where we were really off, right? Because that's a learning opportunity, and we have definitely a very strong culture of continuous improvement and learning, and so we do, very kind of religiously go back and do reviews of every one of our investments, look to see what went right, what went wrong, and what can we pull out of that for as best practices for the entire team to learn from our experience. Because we're 50 people now. We definitely don't want people to be repeating mistakes that I have already paid dearly for personally, and the fund is paid for. But I think that's important that we're very, very transparent, that we do take that time to reflect. Again, not from a finger pointing, but from a learning exercise, and bring that to the rest of the team so that they can benefit from that experience as well.
And when you mention really off, you mean really off negatively, but also an upside? Or
Exactly. It could be something that's just absolute. I mean, believe me, we've had also very, very bizarre positive surprises over the years. And just to understand, how did that happen? What did we fail to see? One of our portfolio companies, I remember we ended up selling it within, what was it, maybe 14 months, something like that. I didn't even have time to implement the ESOP by then. And we sold it for 9 to 10 times our money, right? I mean, we definitely didn't expect that to happen, right? What did we learn out of that, right? What industry trend did we underestimate? What competitive tension amongst the incumbents did we underestimate? I think all of those are really interesting learnings that then we can apply for our future investments.
I think that's very impressive, and it's a golden nugget again, because especially when we look at FTX, okay, it's so easy not to look at the startups that do very, very well, and we are like, oh yeah, we were great, and we don't even try to understand what's happening, and we focus on the ones that are not doing well. And I'm very impressed you're doing both, looking at the one where really off is the first way. I want to ask about these intensive capital startups. How do you think about them, and what best practices which are different for this type of startups? I mean, clearly the reserve you're keeping, the follow investments. How do you think about this?
So, I think that there are some business models that are just simply too capital intensive to be attractive VC targets for our fund, right? We have a certain size. I mean, right now we have, between our funds and mandates, we have about 500 million euros under management. But even with that amount, which isn't a small amount, it's still not sufficient to finance certain types of business models. So we might just simply be the wrong partner for some of those companies. But we do challenge, we're in the process of investing right now in a Finnish company, which we had discussions with them 2-3 years ago, and we told them that we weren't going to invest because their business model was too capital intense, and it was too risky in our point of view of again, building up manufacturing capacity or acquiring manufacturing capacity, and not really having the order backlog to sustain that capacity. The company has made huge progress in the last couple of years, changed their business model, and right now we're leading an investment into that company. I think that's, companies shouldn't change because we don't like the business model that they've chosen, right? We can give them feedback. It's really the management team themselves who have to decide. I'm not going to invest in a company knowing that we're going to try to force the management team to do something that they don't think is the right the right thing to do, right? So sometimes we can also open up their eyes a little bit to other models like toll manufacturing, putting them in touch with other partners that they can work with who already have the manufacturing capacity in place. I think that's sometimes they haven't thought about it or haven't had the right connections to implement that. So I think that those are all quite important. But what I would caution companies from is taking on debt too early, taking on too much debt for financially difficult times, right? A lot of companies in the past few years, when things were just going gangbusters and everybody thought the curve only goes up, they took on a lot of debt. And they took on debt with covenants that were quite difficult. Again, the entrepreneurs are very optimistic. They can't imagine themselves actually tripping covenants. We were looking at a company not too long ago in the US, and in our due diligence, we realized that they were in violation of their covenants, and the company didn't even realize it. And so then we went through an explanation to them about all the bad things that can happen when you're tripping covenants of your debt, right? And look at this clause, look at this clause. And I think also a lot of the company counsel needs to to advise their clients, these startups, much more robustly as far as what are all the bad things that can happen. And there are certain types of debt and certain amounts of debt that I think that's fine if you've got a company of a certain size. But I would really caution companies from thinking that taking on debt is a way to resolve a capital-intensive business model.
Yeah, I think in the last 2 years, when everything is going up and everything is going well, a non-dilutive financing sounds good, especially when the interest rate was so low. I think today this is definitively no longer the case, and I think we have to rethink what that means for this, especially these capital-intensive companies.
Refinancing them. I mean, we have one of our portfolio companies talking to the bank about doing a refinancing, and the advisors are saying we're lucky if we can get it refinanced under 20% interest rate.
Wow.
And having a significant amount of money that needs to be parked in the account of cash just sitting there, right? So you need to have 5 million of cash parked on your account, and you're going to be charged 20% interest rate, and there's all kinds of springing warrants if you trip the covenants. I mean, at the end of the day, the bank is going to end up owning the company, right? Unless everything goes really well. And there are too many things that are outside of the control of the entrepreneurs, right? When you get into, their war, inflation, economic crisis, logistics problems, right?
Yeah, and in the industrial space where we invest, the startup's own customers could change and could reduce their orders. So there's a lot that needs to be considered. Mm-hmm. I want to ask one more question, which is, how do you see an early stage company where they come to you and they say, I could have two go-to-market. I could do licensing, high margin, smaller revenue, or I could do the materials or whatever it is that they sell, and then it's much lower margin but much higher revenue. How do you think about the startups when they're not even sure which go-to-market, and how do you guide them or advise them?
Yeah, I think we try to explain to them kind of where we see that path leading them, right? If it's a licensing deal, we can say, look, this could be a great kind of lifestyle business, not in a really negative way, but hey, you'll be profitable quite early. You don't have to go through the big hassle of building up big operations, but just be realistic. Like at the end of the day, you're not really going to be able to sell this company to anyone more than the party that you just gave an exclusive license to, or a multiple licenses to, right? That's just there are some entrepreneurs where that's a more attractive option for them personally, right? And they choose that, and that's their right to do so, and that's great. But there's there's not much room for us to play part of that journey, right? The other side, the other way is hard work. It's really hard work. We have tremendous amount of respect for these entrepreneurs, right? A lot of them have the, either they'll be successful or they'll die trying attitude. And those are the ones that, that we end up investing in, obviously, and they should also rely on their investors to help them through that, because we've invested in dozens and dozens of companies over the years. There's certain things that we've seen before, certain elegant solutions that we've seen before, and we can hopefully help them to go down that perhaps rockier journey, but hopefully financially a more successful journey for them as well in the end.
Very nice. Gina, I want to talk about something very important you're driving. I went to your event earlier this year and you talked about ESG and ESG standards and how it could be deployed smartly to startups. Mm-hmm. Want to share a little bit about this initiative and what you hope it will bring?
Sure. Yeah. So at the European Venture Fair, we have our typical roundtable, and Patrick Sheehan from ETF and I kind of came together and said, we really should talk about creating best practices around ESG, because ESG is important. Both of our funds, having our roots in sustainability well before it was kind of a buzzword or a place to be. But we need to be practical about how we implement it. And the VCs that are implementing it should not be at a disadvantage. Again, talking about term sheets and stuff, our term sheet has ESG clause in there, and we've actually had some startups say, take it out, and then we'll consider you. And I said to them, so what problem do you have? Do you have a problem with the child labor part or the anti-bribery part? When they think it through, they actually don't have a problem with it, right? Yeah. And this is about good company building practices, right? But we need, as an industry, we need to come together, just like we do about terms and conditions. We talk about pay to play, liquidation preference. It could be all, and you can have variations, but we should agree on certain common principles, right? And I think we, as an industry, particularly in this kind of climate tech industry, we all have very similar views about ESG, but we have to find a practical way of implementing it. So at the event, we asked everybody who wants to be part of it. We got a lot of people giving us feedback saying they want to be part of it. We set up a SharePoint site. We gave everybody access to it. We uploaded our term sheet, our policies, encouraged everybody else to do the same so that we can learn from each other. It's not a competitive advantage that we have by having these ESG principles. So there's absolutely not an issue on our side to share that. Right?
It's the right thing to do.
Yeah, exactly. And we also have Peter Helle from Taylor Vessing, who's also spent a bit of time, because obviously at the end of the day, it has to end up in the investment documents. And over time, I'm hopeful that, just like we've done in many other areas, that we will collectively develop kind of standards around ESG, and that it will not be something exotic anymore, but it'll simply be an important part of good company building practices, right? And people who think it's irrelevant, I think, will be quite surprised when it comes to selling these companies to large corporations, because they will do due diligence on ESG issues, right?
Actually, if we think about the exit strategy for a startup, public company, an acquisition by a big corporation, both will care about the ESG practice that's been developed over time and the on-ramping into that exit strategy. Exactly. I think the challenge and we invest early stage as well. The challenge is to find something that's not too onerous for the startup when they are very early, and find this granular approach over time.
Exactly right. Exactly right. It needs to be practical, right? We don't want companies to have to hire additional employees because of ESG. It should just simply be a part of how they manage their company and how they manage their risks as well.
Thank you, Gina. This was an amazing interview with you, with so many golden nuggets and some wisdom. So thank you so much.
Great. Thank you, Nicolas. I appreciate it.